Well, let's take a deeper look at the Bank of Canada's decision with two economists. Armine Yalnizyan is the Atkinson Fellow on the Future of Workers, and Randall Bartlett is Senior Director of Canadian Economics for Desjardins. Welcome to you both.
Hi.
Randall.
Thank you for having us.
Randall, let me start with you. Governor Tiff Macklem had signaled the bank was prepared to start raising rates again. There was speculation, though, whether the bank would do it today or perhaps wait until July to see some more economic data. What do you make of the bank's call to move ahead today with a hike?
Yeah, it really was a nail-biter of a call coming into this. We thought it was roughly even odds that the bank would hike today, and so it didn't come as I think all that much of a surprise to financial markets and economists that they did. And a big part of that was what the Bank of Canada calls an accumulation of evidence leading up to today's interest rate hike, where we've seen that inflation has been moving higher, that core inflation has been proving sticky. Real GDP growth came in much stronger than the bank had anticipated in the first quarter, and really, the stack hand signal to be a lot of strength going to the second quarter of this year. The labor market remains much stronger than the bank anticipated. So all of this accumulation of evidence suggested that the Bank of Canada could hike today, and ultimately did, and that left the door open for another hike in July as well.
Armine, what's your take on the timing of this? We have the Bank of Canada admitting demand is more persistent than anticipated. Randall just went over some of the evidence that the bank is citing. What's your view?
Well, I guess I'm not as that was obvious as Randall, because you can take a look at exactly the same evidence and see conflicting counter narratives. For example, in very strong first quarter growth, the month of January was when it was the strongest. It's really fallen off a cliff since then. And we're seeing all sorts of evidence that savings rates are collapsing. Only 30% of variable rate mortgages have refinanced. We are looking at lots of slowdowns. And whereas wage growth has caught up to now headline inflation, it's still well below, real wages are still well below where they were before this round of inflation. So people's purchasing power has really been big. And we're seeing the biggest increases in inflation rates in the very thing that the Bank of Canada is in charge of, mortgage costs. So 28.5% higher costs this year than last, which is now cascading into the rental market. So, you could have argued that even though Canada was one of the first countries, along with the UK, to start raising rates, and the first country to pause for as long as it did, that this is not the time to go forward. It's time to watch the data actually gel in a particular direction. An increase from 4.3% to 4.4% inflation rate is a rounding error. It could be adjusted in a couple of months. And next week, both the ECB and the US Federal Reserve will be making a rate announcement, and it is widely expected they will raise rates. And if there was one reason to raise rates now, it is to close the gap that might be otherwise growing with the U.S., which might skew capital markets.
Okay, Randall, I want to go back to the question of inflation that Armine's talking about. The bank says inflation will get down to 3% this summer, according to their estimate. But the bank also saying that concerns have increased about inflation getting stuck materially above the 2% target. I know that observers are always parsing what the bank says, reading the tea leaves of what kind of language they use. What's your sense of what the bank is saying today about inflation?
Well, I think there's a big difference between what we're seeing in terms of the headline inflation in Canada and what we're seeing in terms of some of the measures of underlying inflation that the Bank of Canada uses. Now, to reiterate Armine's point, we had an increase last month of inflation of 4.4% from 4.3%, which I agree is essentially a rounding error. And we think that headline inflation will continue to track lower going forward and in line really with the Bank of Canada's expectations. But the concern of the Bank of Canada goes beyond just what the headline inflation number is. When we look at some of the core inflation numbers that the Bank of Canada uses, whether that's the TRIM measure that it uses, median, or whether it's the core services measure excluding shelter, so excluding the mortgage interest cost category that Armine was referring to, we see that those have remained very sticky in the range of about 3.5% to 4.5%, and that they've been moving sideways now for months. And so really the concern, I think, of the Bank of Canada is not so much what headline inflation is doing and what it's doing from on a month-to-month basis and small changes up or down. It's really what's happening to core inflation, the underlying inflation we're seeing in the economy, which again has been moving sideways now for months and really is showing very little sign of starting to track lower. And I think that's really where the Bank of Canada's emphasis has been, certainly in today's press release, as well as in communications, over the last months, is that that's really where it needs to start seeing material movement going forward, and where we haven't seen a lot of momentum moving in the right direction.
Right, and Armine, you mentioned mortgages. Randall just did as well. So Canadians are certainly looking at interest rate hikes through the prism of their cost of living, their mortgages, affordability. Should Canadians be confident that the bank's current policy is going to get things under control? They've talked about 3% this summer, but again, there is that talk of getting stuck above that 2% target.
Well, there's two parts of my answer to you. The first is that all the things that led to low prices and low inflation targets of 2% for decades, all the factors that led to that, China being the factory of the world, the low wage factory of the world, fairly steady and efficient global supply chains, no wars, no big wars that involved a lot of players, and no extreme climate events. All of these things are now reversed right now. So we've got more headwinds on higher prices than we did for the last 30 years. But we are using the same playbook that we have always played, and it reminds me of that old chestnut, the beatings will continue until morale is improved. We are raising rates because that is what the Bank of Canada does. There are other tools in the tool bag. We have them in our own past in Canadian history of fighting inflation. But really what the world is doing in lockstep is doing what it has done since the 1980s. Inflation goes up and so do interest rates. You will stop spending, and so that's what will cool rates. But the irony here is that raising the rates to cool spending is raising the cost of the biggest line item in any household's budget, whether you're a renter or an owner, whether you have a mortgage or you pay rent, whether you're rich or poor. Housing costs have gone up the most. So yeah, you can parse out shelter costs, but you take a look at every single item that is in the CPI basket, and the fastest growing item in terms of cost is mortgage interest costs, and that is leaking into the rental housing stock market as people stop being landlords and they start turning to short-term rentals to get higher rates. So it's an terribly ineffective policy if you are trying to slow down price growth.
Okay, we just have a quick moment left, so I want to ask you both very quickly. The bank could raise interest rates again next month, and certainly people are wondering if we are entering another period of multiple rate hikes. What are the two of you going to be looking for in the numbers over the next few weeks as we try and figure out what the Bank of Canada might do next? Armine, let me start with you.
Yeah, I think we're looking at what the jobs report is going to say on Friday. We're going to look at what the next CPI print is going to say. But even more carefully, next week is when the European Central Bank and the Federal Reserve in the United States makes their rate announcements. And I think that's going to speak volumes as to where we go in this parade.
And Randall.
So I think the Bank of Canada is really going to be focused on what we see in terms of GDP going forward. I mean, we're expecting that it's going to be strong in April, and in May it's showing a lot of strength as well. That's really very much surprised us, and I think it surprised the Bank of Canada as well. So we're going to be looking to GDP. We're going to be looking to core inflation, those measures that the Bank of Canada has really been laser focused on recently in terms of deciding policy. And finally, obviously, there's a labor market report that's going to be coming out on Friday that Armine mentioned. We're going to be looking at what we're seeing in terms of wage growth and also in terms of employment gains and where the unemployment rate is going.
Okay, we have to leave it there. Randall Bartlett and Armine Yalnizyan, thank you both.
Thank you.
Thank you.